Well, coming up next, here we go. We're talking about crypto and taxes and how to maintain your wealth with Computis and Elizabeth Dodge. And I don't know why, Elizabeth, you're going to get this more and more as you get more into the crypto space. I know you've been in a little while. I'm going to do something a little fun now, because when I see your name, because of the crypto industry, I think of Elizabeth Doge and I think of Dogecoin. And this is why I like to use it in the background sometimes. You get the little Doge doggy in the background. Anyway, just a little fun joke.
No relation.
lighten the mood a little bit. But Elizabeth Dodge, thank you so much for joining us. Thank you for also being a sponsor here in Computis. You guys are doing some great things. So if anybody is a crypto trader and needs to get their taxes in order, this is the lady you want to speak to. So with that said, I'm going to pass it over to you.
All right. Well, thanks, Jeremy. I appreciate it. Hello, everybody. Hope you don't mind the office atmosphere. I'm going to share my screen and pull up my PowerPoint. It's great to be here. Thanks, Jeremy and Christina. I appreciate it. And I'm just going to go over a few things with cryptocurrency taxes that just an overview so people can have an idea of you know, how to take care of your taxes. Okay, so first of all, let's go over a couple of things that we want to go over. We want to be able to understand a couple of things. Understanding the tax law is most important. When you make decisions about your taxes, you want that to be based on tax law, not what you've read on the internet, not what you've heard from your best friend, but what actually is tax law, which is what the IRS is going to use. We're going to go over a few key definitions. We're going to go over some tax treatment of some basic virtual currency transactions. And we're going to talk about how to minimize your tax liability. And that's where we get into, you know, maintaining your wealth, is making educated decisions about how you trade your cryptocurrency and how you decide to calculate capital gains and losses. And then we're also going to talk about a couple of ways that you can actually have tax-free virtual currency income. All right, I have a little caveat here. I am a certified public accountant, but really this presentation is it's an overview of cryptocurrency tax, but cryptocurrency taxation is very complicated. This is just a brief overview, and I highly recommend that you consult a tax professional so they can help meet your unique individual needs. And then past that, let's just go into this. What I wanted to go over first is tax law. There are several major notices from the IRS. The first one, I think everyone remembers, was in 2014. And basically, they define cryptocurrency as convertible virtual currency. So you'll hear me using virtual currency during this presentation, and the reason why I do that is that's how the IRS defines it. Basically, the IRS defines it as a digital representation of value. It's not really real currency, but it can be exchanged like real currency. Most recently, back in, I think it was October last year, the IRS also came out with some revenue rulings about hard forks. And basically what they ruled was that if there's a hard fork and you receive a new cryptocurrency, then that cryptocurrency is taxable as income. And you will value that at the fair market value at the time you receive it. If it's a soft fork and you don't receive any cryptocurrency at the time of the transaction, then there is no taxable income. And then finally, I want to point out, and we'll make sure you get the link, but the IRS has a FAQ section on their website now that is very, very helpful. It gives lots of definitions, gives a lot of detailed information on specific topics, especially about basis, fair market value, etc. I know this is all boring, but this is all really important because it can make a huge difference. And the IRS is making an effort to audit people who they know have had cryptocurrency transactions. They're using Chainlink to follow transactions on the blockchain. They're actually asking for accountants that have experience with cryptocurrency to help them with their audits. So it really is important that you start keeping your records straight and be able to, have the information in case you ever are audited. So, what are the elements of a virtual currency transaction? The first thing is basis. Basis is basically how much you have invested in property for tax purposes. So let's take Bitcoin. If you paid a $5,000 cash for this Bitcoin, then that's your basis. That's what it's worth to you. And if you sell it, whether you sell it for more or for less, will be how you calculate your capital gain and loss. So it's the purchase price, but it also includes all the other expenses that go along with it, including purchase expenses, and in this case, the transaction fees. So whenever you're calculating the basis, the transactions fees are part of the cost. And although sometimes those can be a nominal amount, there are times when that can be even a larger amount. And finally, let's say that you didn't purchase this Bitcoin with cash. You actually traded it. You traded some Ethereum for your Bitcoin. Well, then the basis of your Bitcoin is your exchange price. So it's the fair market value in USD at the time that you received it. So if you, traded it on Gemini and you know what their fair market value of the Bitcoin was at the time, then that's what you would use as your basis. So fair market value, let's just talk about this because this is another key element I really think that you should have an idea of. Fair market value is basically what the property would be worth between a buyer and seller who both have a reasonable knowledge of the market and neither one of them have to buy or sell. And what that means is somebody's not under duress, they need money fast, and so they're willing to sell it for a cheaper amount than it's actually worth. So this would be just a fair handshake transaction on exchanging the value of the property. It's kind of surprises people to know that the taxpayer is actually required to determine what the fair market value of their cryptocurrencies are. How are you going to figure that out? Well, as I just stated, you could use what you buy and sell it for, like on Gemini or Coinbase, KuCoin, any of the others in doing that. So you can use exchanges, you can use CoinDesk, CoinMarketCap, and there are some volume weighted average price companies out there that will help give you a volume weighted average. But whatever you use, the most important thing is that you determine what the fair market value is in a reasonable manner and that you consistently apply it. So what does that mean? Well, let's just take a quick look at CoinMarketCap here. And you can see this was Bitcoin a little while ago today, listed at $9,000. So at that particular moment in time, you could say, well, I used CoinMarketCap's pricing and it was worth $9,159. Now let's say you have to go back and look up the fair market value from prior years or prior weeks or months. If you go down here, they'll give you some historical data and you could use that. But what I mean that by applying it in a consistent manner is that you would not want to show that you purchased Bitcoin at the high price and then turned around and sold it at the low price, because that's going to skew the results. So basically what you want to be able to do is choose either the opening price, the high price, the low price, or the closing price, and use that consistently for buys and sells and for trading. So what is the date of receipt? This is another very important factor when calculating your capital gains and losses. And basically, it's the date that you have dominion and control over your cryptocurrency. So once it's been deposited into your wallet or into your exchange account, and you are able to transfer it, sell it, exchange it, or otherwise dispose of the cryptocurrency, that will be the date and time that it is your receipt. And that would be when you calculate the fair market value. I know I'm probably coming up with some questions here, but I'm going to try and save a few minutes at the end for anyone who has questions. So we'll get to those. All right, so what are some virtual currency transaction types? Well, first of all, let me go over this. In the 2019 tax return, for the first time, the IRS asked a specific question. At any time during 2019, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? And by law, you have to answer this tax return question in order for the tax return to be complete. So the IRS is truly getting serious about following these transactions. So when you receive airdrops for promotional purposes, that's considered ordinary income. If you get a new currency from a hard fork, that's ordinary income. That means it's taxed at your regular tax rate. Other ordinary income is mining, payments received for products and services. And there are actually people who have been getting paid wages in cryptocurrency. And then capital gains and losses occur when you sell it, spend it, or trade it. So once again, ordinary income would come from mining, come from airdrops for promotional cryptocurrency that you receive. If you receive it, like for instance, if you accept Bitcoin as payment, then that's regular income. And then if you receive wages, that's also regular ordinary income. And what that means is it's taxed at your regular tax rate. I think we've kind of gone over the hard fork, so I'm not going to elaborate that on anymore. But mostly, if it's a hard fork, you receive a new cryptocurrency, you're going to have to pay ordinary income on that. All right, so how capital gains are realized when property is sold or exchanged. So if you sell your Bitcoin or you exchange it for another cryptocurrency, or let's say you buy a sofa on overstock.com, or you buy a cup of coffee at Starbucks, that actually is a taxable transaction because you are taking a cryptocurrency that you purchased or received at one fair market value, and then when you use it, it's at a different fair market value, and you actually have to calculate the capital gain on that. Now, if you've had the cryptocurrency for less than a year, that's considered short term, and you're going to be taxed at your regular tax rate. But if you've held it for more than a year, you do get a better tax rate at 15%. So it's better to hold on to your cryptocurrency for at least a year so that you're paying a lower tax rate when you do have to do that. So again, capital gains and losses occur when you sell your cryptocurrency for fiat, when you exchange your cryptocurrency from one to another, or when you use it to pay for any kind of goods and services. So a lot of the questions out there for how to calculate your capital gains and losses is based on which method of cost basis you use. There's a lot of argument about using first in or first out. That means the first Bitcoin you bought is the first one you sell. Last in, first out, the last Bitcoin you bought is the first one you sell. There's other ways of costing, using the highest cost first or the lowest cost first or average. And this gets really confusing. And so everyone's like, oh, which one am I going to use? What method is legal? What's going to keep me from being in trouble? Well, the fact of the matter is it's your choice. Virtual currency is personal property. It's just like a car or your home or the money that you have or jewelry. So it's your right and your privilege to sell it whenever you feel like. So you can use whichever method you want. First in, first out, and last in, first out are easier. But really, specific identification is the better way to go. And we'll talk about that right now. Also, you need to keep in mind that capital losses are limited to $3,000 per tax year. So you don't want to build up a bunch of losses that are going to take you years to be able to write off on your taxes. So I've done a small sample of a Bitcoin sale for you so you can get an idea of how this works. And I know this is complicated, but if you look at it, it's pretty straightforward. Let's say you have 4 Bitcoin, and these are the purchase dates that you purchased them, and these are the purchase prices. Well, if you use first in, first out, and you sold it on July 1st, 2019 at $10,089, then your gain's 95.20. You get the 15% tax break, tax rate because it's long term. And so you're going to end up paying $1,428 on that gain. If you use last in, first out, you do actually have a lower gain, but you have to pay the higher tax rate. And so you actually pay a little bit more in taxes. Let's say, well, okay, I don't want to have to pay any taxes. Let's just pick the highest one. Well, if you pick the highest one, you actually do create a pretty large loss, $9,208. But the problem is that's going to take you 3+ years to write off because you're only allowed to deduct $3,000 a year on your tax return. So you'd have to carry over the $6,208 to the next 2+ years. So finally, if you use specific identification and you say, all right, I'm going to choose the Bitcoin that's closest to the price that I'm selling it for, you get the lowest capital gain calculation. And even though it's still short term, you see that the tax liability is only $467.52. So this is just an example of how you decide to cost your Bitcoin can make a big difference in your tax liability. Certainly, you'd rather pay $467 rather than $1,555 or $1,428. And who would like to spend 3 years writing off the other one when you might want to use that at the end of the year or at another year to go against other capital losses? Okay, so again, what you want to do to maintain your wealth is you need to keep really, really good records. Your records need to indicate the date and the time that you purchased each of your cryptocurrencies and the cost of when you purchased it at that time, whether it was a direct purchase of cash or if it was an exchange with another cryptocurrency. You want to carefully match your short-term and long-term capital gains and losses, and to remember that there are limitations to some of the online services that are available. It's easy not to enter all of your information and for the calculations not to be accurate. And you can tell from this calculation that it'd be really easy to overpay your taxes unless you're really looking at it pragmatically. So let's talk about a couple of ways that you can get tax-free virtual currency income. There are many methods, but I'm going to go over 3 of them. You can actually purchase cryptocurrency in your IRA. You can't do it with a regular traditional IRA. You have to use what is called a self-directed IRA, and we'll talk about that in a minute. You can also use it in a health savings account, and you can give it away as a gift or in charitable contributions. When you give cryptocurrency away as a gift or as a charitable contribution, then the value of the gift is your fair market value. So if you paid $5,000 and you decided to give that to your son as a gift, then you would show that it was given away at $5,000 and there is no taxable income on this. And then your son would have that Bitcoin and it would be worth $5,000 to him. What is a self-directed IRA? An IRA that is self-directed is where you turn your retirement account over to a custodian and then you decide what's invested in it. Like right now, if you have a Charles Schwab account, they basically will make decisions for you based on whatever type of account you have. But when you give it to a self-directed custodian, then you can say, look, I want to invest it in cryptocurrency or real estate. And what this allows you to do is to invest in markets and in investment assets that are not the norm that you would do in a traditional IRA. You can control your risk and you can control the volatility in it. It's the same with a health savings account. A health savings account is one where you take a portion of your premiums and instead of doing a traditional low or no deductible health insurance plan, you get a high deductible one. And with the premium that you save, you put that in a health savings account, and that money is actually taken out pre-tax, and any money that you earn on that while it's in there is tax-free. And so then once you do pay any of your health care, it's with tax-free money. And that can add up to quite a bit of money. So what can you invest in if you decide to do this with a self-directed IRA or with a health savings account? Any investment that's allowed by the tax law, which can be real estate, LLCs, private companies, precious metals, cryptocurrencies, nothing illegal. So, you couldn't, invest in a marijuana company. Anyway, basically our key takeaways I hope that you got from this was, number one, make sure that when you are making your decisions that you're relying on tax authority for making those decisions. Remember that there are some key definitions, and you can go to the FAQs with the IRS and look all of that up. The tax treatment of virtual currencies is varied. There's, ordinary income, there's long-term, short-term capital gains and losses. And so the objective is to minimize your tax liability, and when possible, try and do some tax-free virtual currency income. So that's the end of my presentation here. And I wanted to give us a few minutes, not a whole lot, got about 8 minutes here, that I can take some questions. And I see we lost a lot of people.
No, this is great. Plenty of people here. Rhonda, it looks like you have your hand raised. So if you want to unmute yourself and ask away, please.
Elizabeth, so to get the tax-free income, that must be a Roth IRA, not a traditional IRA that you're putting your assets in.
Yes, it's a self-directed IRA, and you can transfer that to a custodian. You have to get certain custodians that will do self-directed IRAs, but you can do that. You can actually transfer. You can actually transfer from any and all IRAs.
No, but what I'm saying is, once it goes over to, I did Bitcoin IRA, but I used traditional IRA. I didn't use my Roth money. So technically I haven't paid the taxes on that. So when I take that IRA out, the whole thing is going to be taxable. But if I would have put it in a Roth self-directed, then it wouldn't have been.
That's true. But the point is that what the self-directed IRA allows you to do is to control the amount of risk and basically the return on that investment. So if you're investing it in cryptocurrencies or even real estate or, personal or small companies, then you might be able to get a better return on that than you would with a Roth IRA that's in a traditional type of investment company. So that's the benefit.
So here's the question. Okay, the mining contracts back in 2017, I lost some money in the crypto. Is it really worth it to go back and do an amended tax return from 2017? Because I'm not.
Sometimes it can. You would have to take a look at how much that was lost. I will tell you this, again, the capital gains or the capital losses are limited to $3,000 per year. Okay. So if it's more than that, you could carry those losses forward and be able to write off some in 2018, 2019, depending on how much of a loss it was, you can take advantage of it, not just to 2017, but and tax years after that as well.
Thank you.
Thank you. You're welcome, Rhonda.
All right. Well, this was really great. There's a lot of things that I learned, Elizabeth. Obviously as a crypto trader, you think you know a lot of things, but as it relates to tax, that is not my cup of tea per se. So yeah, there's a lot of intricacies with trading. It's really good to educate yourself. How can people find you if they want to learn more? Do you guys put out any research or anything else that anybody can take a look at?
Yes, you can find me on LinkedIn. My email was on the presentation. It's elizabeth@computis.io. And please feel free to call. The tax law as far as cryptocurrency can get really, really detailed, especially when you're trying to keep up with transactions that are being transferred from one exchange to another, keeping up with original purchase price, original purchase date, being exchanged for another cryptocurrency and what the fair market values are. And as you could tell from that calculation, it can make a really big difference in your tax liability. And that's part of maintaining your wealth. There is one other thing I didn't go over in my presentation that I want to bring up. Was called tax loss harvesting. So if you keep up with your cryptocurrency transactions during the year and you're coming up in November, December, and you've got $20,000 in cryptocurrency gains, and you're looking at having to pay taxes on that, then you can look at your portfolio of cryptocurrencies and make some strategic trades that would create what I call a book loss, because you're not actually losing cash. But based on what the prices have been historically, you know, you could create a loss that you could then net against that income of $20,000 and reduce your taxable income. And also, let's go back to Rhonda's question. You lost a significant amount of money during the year from mining or, you know, ICO that went belly up, and you're sitting on $6,000 in loss, and you're like, gosh, I don't want to write off 3,000 this year and 3,000 next year. Well, then you might mix some trades and create a capital gain for 6,000, and then you're netting the gain and the loss, and you have zero taxable income. So that would be a time to take advantage of selling a cryptocurrency that had that would cause a really large capital gain, and then you could zero it out. So it's really important when you're doing investments like this, whether it's cryptocurrency or stocks and bonds, whatever, that at the end of the year, you kept track of it and you know what's happening, and you can make some of these decisions to save yourself some money.
Yeah, so to my understanding, like you're saying, and I've done this before as well, which is there's no tax implication necessarily unless you sell, right? So
Say that again.
There's no tax implications until you sell specifically, right?
That's correct.
The tax,
Well,
so if you hold it, right? So if you
hold it, right. There's a tax implication though, if you trade it for another cryptocurrency, that's considered a sale.
Correct. So let's just
Okay.
say I got in in 2010 and I've been holding Bitcoin and I've never sold it. There's nothing taxable at that point, correct?
Nothing taxable.
Let's just say you get in 2017, like you said, right? And it goes down tremendously. Let's just say gets down to 32.50, which it did at some point, right? If I know inherently it's going to go up, if I sold at that moment and then rebought at $1 higher as an example, or at the same exact cost, right? I got basically the benefit of being able to claim all those losses specifically. But then obviously, like you said, if it goes up the following year by 50% on that investment, then that's going to, you know, basically cover all of those losses, to your point. So then there's a zero liability in terms of your tax. Is that fair to say?
Yeah, and I need to double check on all the nuances of that, but a lot of times it's easier too if you go ahead and trade it for another, like trade your Bitcoin for Ethereum and then turn around and trade it back later on. You can do that, yes.
Okay.
Elizabeth, my question is about buying or selling to Bitcoin to get USDT, you know, because you want a stable coin, because some people believe in holding. Opinion about that, because it would still be a taxable, because it'd be just like any other Ethereum.
Yeah, it would still be a taxable event because you know, it's a virtual currency, whether it's a token or a stable coin, they're all fall under that definition of a convertible virtual currency. And so once you trade it from one to the other, whether it's USDT, Ethereum, you know, BNB, Monero, whatever, once you do that transaction, beginning January 1st, 2018, the IRS said that that was an actual sell and buy. You sold your Bitcoin to buy Ethereum, and you have to calculate a capital gain at that time.
Cool. Sounds good. Well, thank you so much. Really appreciate it. Elizabeth from Computis.
Welcome. Thank you. I really appreciated
more?
being invited to do this. It's been awesome.
Absolutely. And then did you share with everybody, I think, your information just so they could learn more?
Yes, again, it's Elizabeth at computis.io. That's computis.io. I'm also on LinkedIn. So you can find me there as well. And I'll be happy to help. It'll be awesome.
Great. Thank you so much.
Thank you.
All right. Thank you. You guys have a great weekend.